Jon Ingram, you manage the Intrepid Fund at JP Morgan that invests in Western European shares. Now, Intrepid means the same as fearless in the English language. When you look at Western Europe, are you without fear?
I think when we look at Western Europe, we have such a large range of companies, about 2,000 we cover at JP Morgan Asset Management, that we're able to distill those down to the very best ideas, notwithstanding the fact there will always be areas within something as big as Europe where there is uncertainty. But by having a best ideas approach, we can really go into the areas where we see certainty, where we see the best likelihood of share price performance.
Now, the very low interest rates, as set by the ECB, are they a reliable base for share performance?
Low interest rates are fantastic. It's fantastic news for European companies. A lot of them are locking in these low interest rates by securing long-term funding through the corporate bond market, which is giving away money very, very cheaply. And that's enabling companies to grow their earnings and return more share to the equity holders through higher dividends.
What are the best investments in Europe at the moment?
The two key sectors we're overweight in our strategies are the European auto space and the European steel space. Within autos, Europe has undoubtedly some of the best auto companies in the world, the likes of BMW, Audi, Mercedes. Allied to this, we also have a recovering European consumer, so we have already the best brands, great companies trading at less than 10 times earnings in some case, and now a strong rebound in euro sales after the last couple of years where people have deferred purchases. The other area is the steel sector, where again we see an increasing GDP coming through in that European recovery, and the European steel names we think are best placed to benefit from that.
And where wouldn't you invest?
I think the one area of Europe that doesn't look cheap to us is the defensive part of the market. I think over the last few years, a lot of people, fearful of what could happen in Europe, have really tried to hide in some of these higher dividend, more multinational companies. Again, we don't think that's necessarily a good place to invest right now. You're paying higher valuations for increased exposure to emerging market consumers, whereas we think what you really want is the domestic plays with exposure to a recovering European consumer, and they trade more cheaply as well.
Which are the Swiss shares that apply most to you?
So the two biggest Swiss holdings for us in the strategy right now are Novartis and Roche, both fantastic, really global pharmaceutical companies. And again, if we look at Europe as a whole, because it is trading at such a discount, if you look at valuation metrics to, for example, the US, you're buying these two companies which are completely global in their client base, the patient base, trading on cheaper valuations to the US pharmaceuticals, for example. So there's nothing to do with the Eurozone slow GDP impacting these pharmaceutical giants. They're selling their treatments all around the world, but you can buy them on cheaper valuations than some of their American counterparts.
But high price-earnings ratios are quite an issue in Switzerland. Have they become an obstacle for investors from outside, from international investors like your fund?
I think if you look at Switzerland in particular, obviously the largest weight there is Nestlé, and that comes into what I said earlier about the area of the market, the defensive area of the market, which we don't see as cheaply valued. So you have a large weighting to stocks like Nestlé. I think overall at Europe, if you look at the PE ratios there, you're really looking at a very depressed earnings number. So that's giving you an artificially high PE level, whereas in the US we've seen earnings hit record highs. We're still some way off that in Europe, and we look for those companies, and we're seeing it come through in the Q2s that we just had. The Q2s show company year-on-year growth of 7% for European companies, only 6% for US companies. That's the first time in 5 years, in 20 quarters, that European companies have grown faster than US. So I think as you see that earnings base or that earnings number go up, the PE multiples will either come down or indeed the market will continue going higher.